28 November 2025, Singapore's government announced a one-off property tax rebate for 2026, 15% for owner-occupied HDB flats and 10% for private homes, capped at $500. This move was widely reported and quickly understood by the public as a form of immediate relief, but when we look beyond the headlines, the rebate's actual economic impact is modest. Compared to the massive pool of CPF savings, over $635 billion as of June 2025, and the billions generated annually by government investment returns, this rebate is a drop in the ocean. The policy is easy to administer and highly visible, but its effect is fleeting. To truly understand its significance, we need to place it within the broader context of Singapore's fiscal system, including how CPF, government investments, and HDB cash flows interact. Let's explore why this rebate, though politically salient, is economically limited. Grasp the scale of the rebate. Consider the numbers behind Singapore's public finances. CPF members collectively hold about $635 billion in savings, which are invested by government bodies like GIC. Over the past 20 years, GIC has achieved an annualized nominal return of 5.7%, far outpacing the typical CPF interest rates of 2.5% to 4%. This difference in returns, when applied to such a large pool of savings, amounts to billions of dollars each year. For example, if CPF balances earn just 1.5 percentage points more annually, that would mean an extra $9.5 billion a year, dwarfing the few $100 million spent on the property tax rebate. This highlights a crucial point. The rebate is tiny compared to the potential gains from adjusting how investment returns are shared with CPF members. The real levers for household welfare lie in long-term policies, not one-off gestures. Rebates' limitations become clearer when we examine HDB's finances and broader fiscal practices. HDB's cash flows involve billions in land purchases and construction costs, with internal transfers between government entities like the Singapore Land Authority. These structural outflows far exceed the temporary relief provided by the rebate. Additionally, the way the government accounts for transfers to endowment or trust funds can make fiscal balances look different from the economic reality, depending on timing and reporting standards. At the heart of the issue is the concept of CPF as an implicit tax. Mandatory contributions reduce disposable income today, and the government controls the spread between what it earns on investments and what it credits to CPF account. This spread, if not transparently managed, can be seen as an implicit tax on savers. Ultimately, while the rebate is politically useful, it does not address these deeper, long-term issues. The goal is to improve household welfare in a meaningful and lasting way. The focus should shift from one-off rebates to structural reforms. Transparent reconciliation of government investment returns and CPF interest policies would make trade-offs explicit and build public trust. Instead of temporary relief, targeted subsidies or CPF top-ups for lower-income households could offer more durable support. Proving HDB's accounting disclosures and clarifying the fiscal timing of transfers would enhance transparency and accountability. Finally, if sovereign investment returns consistently exceed CPF crediting rates, a rule-based mechanism to share some of these excess returns with CPF members could address intergenerational concerns and boost retirement security. In summary, while the property tax rebate is a visible gesture, real progress depends on deeper fiscal reforms and transparent management of public wealth.